Corporate tax in Denmark is often perceived as relatively straightforward, yet the details matter significantly for businesses considering investment, expansion, or restructuring. In this video, we will walk through the key facts you need to understand: how the corporate tax system is structured, what rates and bases apply, how losses and financing are treated, and what to expect in terms of compliance and planning opportunities. This is not intended as legal or tax advice, but as a high-level, practical overview to help management teams and investors frame the right questions with their advisors. Let's start with the fundamentals. Denmark operates a classical corporate tax system, meaning companies are taxed on their profits at the corporate level, and shareholders are taxed separately on dividends and capital gains. The standard corporate income tax rate is 22%, and this flat rate applies to most Danish resident companies as well as to foreign companies with a taxable presence, generally through a permanent establishment in Denmark. Residency for tax purposes is typically determined by place of management or incorporation, so most companies organized in Denmark will be fully taxable on their worldwide income unless a tax treaty provides otherwise. In determining the taxable base, Denmark follows an accrual-based system using financial statements as a starting point, with specific tax adjustments. Generally, business expenses incurred to earn, secure, or maintain taxable income are deductible, while capital expenditures are not immediately deductible, but may be depreciated over time. Depreciation rules distinguish between tangible and intangible assets, and some assets, such as machinery and equipment, can be pooled and depreciated on a declining balance basis, subject to maximum rates set by law. For intellectual property and other intangibles, the treatment may vary depending on whether the assets are internally generated or acquired, and businesses should pay particular attention to how development costs, software, and trademarks are classified and amortized for tax purposes. From an international perspective, Denmark has an extensive tax treaty network that helps reduce double taxation and clarify taxing rights between Denmark and many key trading partners. The country generally taxes worldwide income of resident companies, but provides relief for foreign source income through exemptions or credits, depending on the nature of the income and the applicable treaty. A cornerstone of the Danish system is its participation exemption regime for dividends and capital gains on qualifying shareholdings. Under certain conditions, dividends received from subsidiaries and capital gains on shares can be exempt from Danish tax, which is highly relevant for holding company structures. Typically, the exemption applies if the Danish company holds at least a minimum percentage of the shares in the subsidiary, and the subsidiary is resident either in the EU or in a jurisdiction with which Denmark has a tax treaty, and is subject to a qualifying level of taxation. On the other side of the income statement, interest and financing costs are subject to several limitation rules. Denmark has implemented interest barrier rules that may restrict the deductibility of net financing expenses above certain thresholds based on earnings and asset tests. These rules are complex and can materially impact leverage structures, so groups using significant debt financing need to model the after-tax cost of capital carefully. Additionally, Denmark has implemented global initiatives such as anti-hybrid rules and anti-tax avoidance measures aligned with OECD and EU frameworks, which further constrain aggressive cross-border financing and profit-shifting strategies. Loss utilization is another essential feature of the Danish system. Tax losses may generally be carried forward without time limitation, but there are important restrictions. When taxable income exceeds a specified threshold in a given year, only a portion of the carried forward losses may be used, with the balance carried forward further. There are also change of ownership rules that can limit the use of losses following certain transactions, such as major share transfers or restructurings. For groups, Denmark offers a system of joint or group taxation. Under national joint taxation, Danish group entities can effectively pool results, allowing losses in one entity to offset profits in another, subject to defined conditions and election procedures. International joint taxation, which can bring foreign group entities into a Danish tax group, is also possible but comes with added complexity and potential exposure, including the need to include foreign profits and losses and potential exit consequences. Beyond corporate income tax, businesses should also understand the broader tax environment. Denmark applies value-added tax, or VAT, at a standard rate on most goods and services, and companies above certain turnover thresholds must register and comply with VAT reporting and invoicing rules. Employers are responsible for withholding tax on employee income and contributing to Social Security-type schemes, although Denmark does not have traditional employer social contributions on the same scale as some other European countries. Instead, much of the welfare system is financed via general taxation. Withholding tax on outbound payments is another important area for cross-border structures. Dividends paid from Danish companies to foreign shareholders may be subject to withholding tax, typically at a domestic rate that can be reduced or eliminated under tax treaties or the EU Parent Subsidiary Directive, provided anti-abuse rules are satisfied and the structure has sufficient substance and business rationale. Interest and royalties are, in many cases, exempt from withholding tax, especially when paid to associated EU entities under the Interest and Royalties Directive, but anti-avoidance and beneficial ownership tests apply here as well. Transfer pricing is a critical topic for multinational groups operating in Denmark. Related party transactions must reflect arm's-length terms, and Danish tax authorities place increasing emphasis on robust transfer pricing documentation, functional analyses, and benchmarking studies. Certain entities are required to prepare and maintain local and master file documentation in line with OECD standards, and larger groups may be subject to country-by-country reporting. Failure to comply with transfer pricing documentation requirements can lead not only to adjustments and penalties, but also to a reversal of the burden of proof in disputes with the tax authorities. From a compliance standpoint, Danish companies must file annual corporate income tax returns, typically based on the calendar year or an approved fiscal year, with deadlines that leave limited room for delay. Advanced tax payments are common, and interest or surcharges may apply for underpayments or late payments. Electronic filing is the norm, and businesses should ensure their accounting systems and processes are aligned with Danish requirements for record-keeping, invoicing, and digital communication with authorities. In terms of planning, while Denmark is not a low-tax jurisdiction, it offers predictability, strong treaty coverage, and a stable legal environment, which are all valued by international investors. Holding company and regional headquarters structures can be attractive when substance is genuinely present, leveraging participation exemptions and treaty benefits, while operational entities can benefit from Denmark's skilled workforce and infrastructure. However, the strategic use of Denmark in international structures must now be evaluated through the lens of global minimum tax initiatives, such as the OECD's Pillar 2 rules, which Denmark is implementing together with other EU countries. As you assess corporate tax in Denmark, the key is to view it as one component of a broader business case. Beyond the headline 22% rate, the real impact on your organization will depend on your capital structure, the nature and location of your assets, how you manage intellectual property and intragroup services, and the degree of substance you maintain in Danish entities. Engaging early with local tax advisors, modeling different scenarios, and aligning tax structure with commercial realities will help you avoid surprises and capture available efficiencies. If Denmark is on your shortlist for investment or restructuring, make corporate tax a front-loaded work stream in your planning process rather than a late-stage feasibility check, to ensure your business can operate confidently and compliantly in this jurisdiction.